Imagine signing a mortgage that quietly controls the next 30 years of your life. Not because you bought a mansion, just because everyone told you property was the safest investment you could make. For the average taxpayer, that's where the story usually begins. And sometimes where financial freedom quietly ends. Property investing has become almost a cultural rule. Buy a house, watch it rise in value, retire wealthy. It sounds simple, but the math underneath tells a different story. Let's say you buy a rental property with a small down payment. The bank owns most of it. Every month you're paying interest, maintenance, insurance, taxes, repairs, and unexpected costs. One broken roof can erase months of rental income. Then there's vacancy. Even one empty month can wipe out your annual profit. People love to point at someone who bought a house 20 years ago that tripled in value. They rarely mention the years of mortgage payments, renovation bills, legal fees, property taxes, and inflation quietly eating into those gains. Meanwhile, your money is trapped inside a single illiquid asset. Need cash quickly? You can't sell one bedroom. You sell the whole property, often after paying agents, taxes, and months of waiting. The irony is that many average taxpayers aren't really investing in property. They're investing in debt, hoping rising prices will save the numbers. That strategy works brilliantly